Hello there everyone, today's video is all about the Non Resident Landlord Scheme. So what is that? Well, it applies to expats living overseas who are non-resident in the UK, who nevertheless have a UK rental property, a buy-to-let property or properties, and their tax obligations on the rental profits, the ongoing year-on-year profits from having those rental properties. Separate from the video I've recently done on the capital gains tax for those expats when they sell the properties. This is their year-to-year tax obligations on the income tax on the rental profits. So, what is it all about? Well, basically, there is a rule in place called this National NRLS, National Resident Landlord Scheme. And what it means is that HMRC say that it's pretty difficult to chase landlords who live abroad, live overseas, for the tax that's due. So basically, tax is always due on UK sourced properties. That's the bottom line. So it doesn't matter if you are an expat living in anywhere in the world, if you have buy-to-lets in the UK, the fundamental taxing rights is on the UK tax authority because the asset is situated in the UK. So that's the first thing. So you've got an obligation. Now what this NRLS says is that it's meant to make HMRC's life easier to collect the tax that's due. Because, like I've just said, it's going to be quite difficult for HMRC to chase landlords living 5,000 miles away if they don't conform with their tax obligations. So what it looks to do is to say, instead, we will impose the obligation on collecting the tax on the rental business with the letting agent. So the letting agent has to withhold 20% of the rents that are paid to the overseas landlord. Now, if there's no letting agent, then the tenants are supposed to do that. Can you imagine that? The tenants are supposed to withhold 20% of the rental amounts that they pay to the overseas landlord, and then they're supposed to make good this money to HMRC every quarter. So that's a right administrative burden for everybody, especially for the tenants. You imagine you're a tenant in a house, and not only have you got to pay rent to an absentee landlord, but you're supposed to work out how much you should withhold paid over to HMRC on behalf of the landlord. Forget it. Who wants to do that? So thankfully, there is, under this NRLS scheme, an option that says if you are the landlord and you complete a declaration of form, then you can apply to not have to have any of your rent subject to this deduction, and you can then make good the tax that you owe at the end of the year. So you can apply for this if you're in good standing with HMRC, various conditions. It's not that difficult to get that status, but all overseas landlords, I would suspect, would want to have that status rather than having to have tax withheld by the tenants. Certainly the tenants don't want to have to withhold the tax and have their obligations to report it on forms every quarter to HMRC. So you're a non-resident landlord, you need to apply for this form to say that you can receive your rents from the UK gross and then reckon up with HMRC at the end of the year via a tax return. Because you have to do a UK tax return regardless of if the tax is withheld by the letting agent or the tenant, or you pay gross. You have to do a tax return and reckon up with HMRC. So if you are an expat, remember as well that you do get the personal allowance if you have a British passport. So you've got a British passport, you come to do your tax return. Let's say the only source of UK income that you need to put on that tax return is the rental profits of your UK property business, whether it's one property or more. And let's say, for example, that the profits come to £10,000. That's the only thing that goes on your UK tax return. You're working in Dubai, you're getting a good salary as an expert over there. That doesn't go anywhere near your UK tax return. The only thing that goes on there, assuming this example, is your UK, what we call sourced income, i.e. the profits from the property business that you have. And let's say that they are £10,000. So £10,000 would go on your UK tax return. Now, personal allowance, like I've said, if you're a British passport holder, the personal allowance this year is just above 12,500. It's 12,570. So you don't even earn enough from your UK property business to pay any UK tax because it's all covered by the personal allowance. Fantastic. So, but you still have to go through the rigmarole of doing a tax return. Even if there's no tax to pay, you still have to submit one every year. Fine. So let's take, assuming this first example, that this guy has registered for the, to have the rental income paid to him gross. So he's got in his hand all of the profits, and it's £10,000, but he's covered by the personal allowance. Now, what about the scenario where the landlord hadn't registered to receive the payments gross and the tenants or the letting agent withheld the tax? So let's just assume, keep the maths easy, right, that there was the profits of the business equal the rent that was paid. There's no expenses. So let's say it's £10,000 rent, and 20% of that, 20% was withheld under the scheme by the tenants, and the tenants paid 20% of the 10 grand to HMRC, and they did it over 4 quarters. So 20% of 10,000 being £2,000. So £2,000 over 4 quarters, that's £500. So £500 every quarter was paid over to the UK taxman from the tenants. So we come to the end of the year, same scenario, still have to do a tax return, but in this case, the guy has suffered the withholding tax that the tenants withheld and paid to HMRC. So on his tax return, what it will look like is exactly the same starting point. £10,000 was the gross income, the rents that he received. He didn't receive it though, did he? He received £8,000, but nevertheless, he still puts on there £10,000 is the gross amount. £10,000 covered, of course, by the personal allowance, so there's no tax to pay. But then on the bottom half of his tax return, there's it'll say amounts deducted, and that £2,000 he, of course, has suffered. It's a bit like how PAYE works on a tax return. You put in your gross amount, you put on how much you've suffered from pay as you earn. So in his case, he put on the £10,000 covered by the personal allowance, 0 tax, but he suffered 2 grand. That £2,000 will then get refunded. So on his tax return, he puts bank details of where to put the refund, and HMRC will refund that tax, the tax that has been withheld by the tenants or the letting agent and paid over in the course of the year. So that's why it's, everything comes out in the wash eventually, whether or not, it depends on what's on your tax return. If there's no tax obligation, there's no tax obligation. You just either don't pay the tax on the deadline, or you get a refund of the tax that has been withheld under the non-resident landlord scheme. Either way, you are still at the same point, the same end game. It's just a timing thing. And of course, it's a bit of a pain to have that money withheld and then you've got to get it refunded. That's why you'd always want to choose to go down opting for the gross status to receive your rents as an overseas landlord without any tax being deducted. So, but you've still got to do a tax return regardless, even if there's no tax. And if you are either getting the rents gross or having the tax withheld, still got to do a tax return, because why wouldn't you? That's exactly where it all comes out in the wash. That's when you can see exactly what the bottom line is. So you need to do a tax return. That is a legal obligation. Right, so, like I said, the obligation to withhold if you haven't got the gross status with the letting agent, or if there's no letting agent with the tenant, which is practically a bit of a nightmare. If I was a tenant, I would not be happy with having to do forms and sending money over to HMRC every quarter. But that's the way it is, unless you apply for the gross status. Now, fundamentally, that just takes care of the UK position. But of course, in this global world, we need to consider other jurisdictions' tax regimes. So let's take an example of an expat living in Dubai. So the Dubai expat, we've just worked out the UK, we've said the UK has what we call primary taxing rights, because the property is situated in the UK. So we work out the UK tax obligation, 0 in this case, fine. But what about the tax authorities in Dubai? Because the individual, of course, is resident in Dubai. And a lot of these countries will say, if you are resident in our country, you will pay tax on your worldwide income and gains, exactly like we do in the UK for UK residents. Now, thankfully for this guy in Dubai, there is no income tax in Dubai. So there is no tax that the Dubai resident, the UK expat living in Dubai, has to pay to the Dubai authorities because they don't want any claim, any dibs on the tax on UK property. They don't want any tax on anything, full stop. Strictly not true. Dubai's just introduced some VAT at a low rate, 5%, but everything else in Dubai, tax-free. Okay. But what if the expat was living in America? So you've got a British national, the British passport holder, expat living in the USA. He's just gone through all this on his UK tax return, no UK tax to pay. But then, what about the US tax authorities' position? Now, at that point, we need to go to the double tax treaties, because the UK has signed double tax treaties with hundreds, there's only 200 countries in the world, but with many countries in the world to say what are the respecting taxing rights of expats and non-residents with property and income all over in the different countries all over the place. So we look at the double tax treaty between America and the UK, and it has a clause on that double tax treaty relating to immovable property. So buy-to-let property. And what it says is, in that double tax treaty, it says that the Americans can also tax profits on the UK buy-to-let property. That's the bottom line. Yes, the UK has the first taxing rights, as it were. So then in America, they also can tax it if you are a permanent resident of America. So let's say you're an expat there, you've got a green card, you are deemed to be a permanent resident, you've got to pay, or you've got to consider US taxes on your UK buy-to-let property. So how it works in the double tax treaty world and what we call double tax relief is that the Americans will also work out what is their tax rates applicable to your buy-to-let property. Now, of course, the rates and the rules are completely different. You know, they may tax it differently at different proportions, different rates, different times, whatever. But the point is, you need to consider it. But thankfully, the double tax relief provisions will say, well, it seems a bit harsh to be taxed twice on the same income stream, taxed in America and in the UK on UK property. But of course, the provisions of double tax relief say that, in this case, what would happen is that the Americans would allow you to knock off the tax that you paid in the UK. Oh, but hang on. We just said that there's no tax to pay in the UK. Okay, so there's no credit going to come off the US tax bill. So then you're stuck with paying US tax on that UK residential property. And that's how it's and that's how the international tax system works. It's all about the fact that where are you resident, and where is the asset from which you derive the income. And look at the tax treaties, and it says, most of them say that both countries have taxing rights. Because it works on the flip side, of course, because let's say you are an expat living in the UK. So let's say you're an American. Let's say you are an American citizen living in the UK, you're resident in the UK, and you've got buy-to-let property in the UK. Again, the UK wants tax on that because it's situated in the UK, but because you're an American citizen, the Americans want tax on it as well. And that's when the double tax treaty comes into play. So, of course, in situations like this, where you reside in non-tax countries like Dubai or places in the Caribbean or wherever, you're getting the best of both worlds because there is zero tax, because the country where you reside doesn't have any tax, and the UK tax is covered by your personal allowance that you get as a UK citizen, and there's nothing else to set it against from UK sourced income. So in most cases, you will pay zero tax in the UK because 12,570 is a reasonable. I would say most absentee landlords or non-resident landlords, most of them, their profits will be covered by that 12,570. The vast majority. So. Just an overview there on the ongoing year-on-year tax obligations of expats, UK expats living abroad, having to make good to HMRC tax on their UK rental profits on their property business, whether it's one buy-to-let or multiple. You've got to do this. You've got to abide by the non-resident landlord scheme rules. And like I said, it would be in 99 out of 100 times you would not want the tax to be withheld by the tenants or the letting agent. Neither would they. So you just put in the form to HMRC and say, I would like to apply to receive everything gross, and I will make good at the end of the year. And then you make good on your tax return, and in 99 out of 100 cases, there's nothing to make good anyway. But you still got to report on that tax return, even if there is zero tax payable. Okay, so if you like this video, please do subscribe right about there, and I will see you soon.